Welcome back to The Deep Dive. Today, we are tackling something huge, really fundamental. We're charting the course of global finance. How we went from a world where money was, well, mostly a free market thing.
Like gold or silver.
Exactly. To the world we live in now, where money is basically created and controlled by government.
It's a massive shift.
Yeah.
And arguably the defining economic story of the last 100 years or so. Our sources today, they're making a pretty bold claim.
Which is?
That the real turning point wasn't some banking crisis you read about or a treaty signed in peacetime. It was World War I.
1914.
Yeah. That conflict, they argue, it fundamentally, permanently changed what money is. It shifted the power to create wealth, to control it, away from individuals, away from markets, and straight into the hands of the state.
Okay, that is a monumental claim. So let's dive in. We've got historical data, right? We're looking at the big economic arguments.
Sound money versus the Keynesian ideas that came later.
And some pretty stark numbers on currency devaluation, I gather. This isn't just a history lesson, is it? It's about understanding the system we all use every single day. The dollars, the euros, whatever you have in your pocket.
Absolutely. We need to be surgical here. First, let's get clear on what our sources call the two foundational truths about government money, things people often miss today.
Okay.
Then, trace the history, the failures, hyperinflation, depression, all that. And finally, understand the system we ended up with after World War II, this thing called monetary nationalism. It's really a journey to figure out how we came to be governed by government money, not just using it.
Right, let's start with the basics. Government money, the common term everyone hears is fiat money.
That's the one, fiat. It's straight from Latin, meaning let it be done, or simply decree, mandate.
So the value comes from a government order, not from the stuff itself, like gold.
Precisely. That's the philosophical leap. Its value is commanded, not, earned through market usefulness like a commodity.
Which brings us straight to the first truth you mentioned, the crucial difference between types of government-issued money.
Yes, absolutely critical. You have to distinguish between government money that's redeemable and money that's non-redeemable.
Okay, explain that. Redeemable is like the old days?
Exactly. Think of the classical gold standard. Government money was redeemable. The government might mint coins or print paper notes, sure, but these were essentially like warehouse receipts.
Receipts for actual gold.
Right. You could, in theory, walk into a bank and demand the physical gold. The government's role was kind of mechanical, minting, printing, but crucially, they couldn't just magically create more gold.
Yeah.
Supply was limited by mining.
But non-redeemable. That's where the power dynamic flips entirely.
Completely flips. With non-redeemable fiat, the money is the government's promise, or its debt, or just the paper itself. There's nothing backing it that you can demand in exchange, except maybe more paper.
And they control the printing press.
They control the supply. Totally.
Right.
No link to gold reserves needed. They can increase the money supply just by deciding to. And importantly, if you try to use something else as money, or, heaven forbid, print your own version of their paper.
You're a criminal.
Instantly. Counterfeiting or using alternative currencies becomes a serious crime. The state carves out a monopoly.
Okay, so they have a monopoly, but that doesn't mean they have total control over its value, right? This leads to the second truth. This idea that fiat value is purely based on decree is, well, maybe not the whole.
Modern textbooks often imply the government just says, this is money, and poof, it is.
But it's not that simple.
No. Governments can pass legal tender laws, forcing people to accept their paper for debts. Fine. But they can't magically impose saleability. People have to actually want to use it, to trade with it.
It needs market acceptance.
It needs market acceptance. And historically, how did paper money get that acceptance? It was convertible. It was a promise for gold or silver, things the market already valued highly. The paper's usefulness came from that link.
So even if a government declares its paper is valuable, if nobody internationally trusts it, or if people domestically don't think it will hold its value, the decree doesn't mean much in practice.
Exactly right. And you still see echoes of this need for real backing today. I mean, think about it. No major central bank operates with zero reserves. They don't redeem dollars for gold for citizens anymore, no.
But they hold tons of gold themselves.
They hold vast amounts of gold, or they hold reserves of other major fiat currencies, like dollars or euros, which themselves are, implicitly backed by the economic strength and, yes, the gold reserves of those countries. Holding gold is basically an admission that they still need a scarce, market-trusted asset to backstop their own paper.
And history gives us plenty of warnings about what happens when governments ignore that market reality, when they try to completely sever the link.
Oh, yeah. The warnings go back centuries. Look at China, Song Dynasty, around the 10th century. They had probably the earliest recorded paper money, the jiaozi.
How did that start?
It started privately, actually. Merchants used these paper notes, these receipts, because carrying around tons of metal coins was inconvenient and dangerous. It was a market innovation, redeemable for metal.
But then the government got involved? Always the way, isn't it?
Well, yes. The government took over the system. And what did they do? They suspended convertibility, stopped letting people exchange the paper for metal, and then, inevitably,
They started printing more.
started printing more to fund wars, state projects, you name it. Within a couple of generations, the value collapsed. Total hyperinflation. It failed because the government replaced real scarcity with a simple decree.
And there's an even starker example, the Yuan dynasty's Chow note.
Even more chilling, yeah. Around 1260, under Kublai Khan, initially it actually worked quite well. They had strict rules on how much could be issued. But again, the temptation too strong. Rules got bent, then broken. The money supply ballooned, way beyond any plausible metal backing. And the sources describe just utter economic catastrophe.
What happened?
Runaway inflation, obviously, mass poverty. And the horrifying detail you sometimes read is peasants being forced to sell their own children into slavery just to get food because the currency was worthless.
Wow. That really drives home that this isn't just an abstract economic concept. Currency collapse tears society apart.
It's the foundation of exchange. When it breaks down, everything breaks down. And this brings us back to that key comparison our sources make.
That non-redeemable government money acts like primitive forms of money except for gold?
Exactly. That's the core argument from the sound money perspective. Think about things used as money historically, shells, beads, cattle. Their supply could often be increased relatively quickly if the incentive was there.
So their value wasn't stable?
Not stable long term. Gold is different. Why? Basic chemistry and geology. It's incredibly hard and expensive to find and extract gold. The new supply each year is tiny compared to the total amount already mined and existing in the world.
That's the high stock-to-flow ratio people talk about.
What's the one? The existing stock is huge compared to the annual flow of new production, printing paper, or adding zeros to a digital ledger. The cost of production is basically zero.
An infinite flow, potentially.
Potentially infinite. Gold scarcity is real, physical. Fiat scarcity is purely political, based on promises of restraint. And history shows that restraint eventually fails when governments face fiscal pressure. They print, the purchasing power collapses, and the people holding the money get impoverished.
Okay, so we see these historical warnings, but they were often localized, temporary failures. The big shift, the one that made government fiat the global system, our sources pin squarely on World War I.
It seems to be the catalyst, yes. Many historians still kind of grapple with explaining the sheer scale and duration of that war. The geopolitical reasons in 1914 don't seem quite enough to justify 4 years of that kind of slaughter.
So the argument is the real difference wasn't politics, it was money.
That's what these sources contend. The key difference between World War I and, say, earlier European conflicts like the Franco-Prussian War wasn't strategy or ideology. It was the monetary system under which they were fought.
How so? What were the constraints before 1914?
Well, before 1914, most of the world, especially Europe, was on the classical gold standard. And that imposed some very real limits on governments wanting to wage war.
How did it limit them?
Your war spending was basically restricted to 3 sources. 1, the actual gold you had in your treasury. 2, the taxes you could realistically collect from your population right then and there.
Which is never popular, especially for a war.
Exactly. And 3, the money you could borrow by issuing bonds. But those bonds had to be paid back, presumably in gold, so you needed the market to believe you could pay them back. This financial discipline acted as a brake on conflict. Wars tended to be shorter because, eventually, someone ran out of money.
So picture yourself as a European leader in August 1914. Mobilizing millions costs a fortune. Raising taxes instantly is political dynamite. Selling enough gold-backed bonds to fund years of total war seems impossible.
The temptation to just print the money must have been immense.
And they succumbed to it. Quickly.
Almost immediately. This is the critical moment.
Right.
Within weeks of the war starting, all the major players, Germany, France, Britain, Austria-Hungary, later the U.S., they all suspended gold convertibility,
Meaning?
meaning they slammed the gold window shut. They declared their paper money would no longer be exchanged for gold on demand. Poof. Just like that, the international gold standard, the system that had defined global finance for decades, was effectively dismantled.
And populations were forced onto government paper money with no backing.
Exactly. They had no choice. And think about what that means for funding the war.
Suddenly, the government isn't limited by the gold in its vaults.
No. Their potential war chest instantly expands. It's no longer just the treasury, it's the entire accumulated wealth of the whole population.
How? Through inflation.
Through inflation. By printing money and forcing people to accept it, the government could effectively confiscate purchasing power, confiscate savings, bit by bit, to pay for the war effort. It's a hidden tax, much less obvious initially than direct taxation.
This leads to that really powerful counterfactual argument our sources raise. What if they hadn't suspended gold payments? What if they'd been forced to stick to the gold standard rules?
It's fascinating to consider. If governments had to rely only on gold reserves, current taxes, and what they could realistically borrow on the open market, how long could that level of warfare have lasted?
The argument is maybe only months. A year, cops.
That's the idea. Once one side exhausted its actual funds, couldn't pay soldiers, couldn't buy bullets, couldn't import supplies, the war would likely have ground to a halt much, much sooner. The suspension of gold convertibility essentially enabled 4 years of industrial-scale bloodshed that might otherwise have been financially impossible.
Allowed the war machine to run on fumes, effectively. Fumes created by the printing press.
Precisely. Financed by what amounted to legalized counterfeiting on a national scale.
And the human cost of this inflation-funded war. It's just staggering. You mentioned the Christmas truce of 1914 earlier.
Yes, that brief, extraordinary moment. Soldiers from opposing sides, British, French, German, spontaneously stopped fighting. They crossed trenches, shared food and cigarettes, played football. Many apparently realized they had no deep personal hatred for the men they were supposed to kill.
Yet the war dragged on for nearly 4 more years.
Dragged on, fueled not by some overwhelming popular demand or clear strategic necessity felt by those in the trenches, but by the government's newfound ability to finance endless conflict by devaluing their own currencies.
We can actually see this devaluation happening in real time, can't we? By comparing the warring nations' currencies to one that stayed on gold.
Yes, the Swiss franc is the benchmark here. Switzerland remained neutral and maintained gold convertibility. So if you track the value of other currencies against the Swiss francs during the war,
You see the inflation tax in action.
clearly, by the end of the war, November 1918, the German mark had lost almost half its value, 48.9% against the francs. The Austro-Hungarian krone lost a staggering 68.9%. Wow. Even the victors paid a price. The British pound lost over 6.6%. The U.S. dollar, despite America entering late, still lost about 3.4%. These aren't abstract numbers. That's the direct erosion of the savings and purchasing power of ordinary people sacrificed to fund the war effort via inflation. It set the stage for decades of monetary chaos.
Okay, the war's over, armistice signed. But the financial landscape is just devastated. Currency's massively inflated. This creates a huge headache for policymakers, doesn't it? The return dilemma.
A massive headache. A political minefield, really. All these European currencies had lost enormous value relative to gold because of wartime printing. So the question was, do we try to go back to the gold standard? And if so, at what rate?
What were the options?
Option 1, return to the current market rate, the rate that reflected all that wartime inflation.
Which would mean?
It would mean openly admitting to your citizens, sorry folks, we destroyed maybe half the value of your savings to pay for the war. Politically, that was just unthinkable for most governments. Suicide.
So option 2, try to pretend the inflation didn't happen. Go back at the old pre-war exchange rate.
Exactly. Try to restore the currency to its former glory, its pre-1914 parity with gold. This sounded better politically, perhaps. Restore confidence.
But economically,
Disastrous.
utterly disastrous. If you declare your paper currency is worth the old high amount of gold, but everyone knows you don't have enough gold to back it up at that rate, what happens?
People rush to exchange the overvalued paper for the undervalued gold before it runs out. Precisely. A massive run on the remaining gold reserves. And huge incentive for gold smuggling. Get your gold out of the country to somewhere its real value is recognized. So either choice was politically toxic or economically ruinous.
It sounds like there was no good option within the old framework.
Which is why the whole question of money got ripped out of the realm of economics and market forces.
And became purely political.
Purely political. subject to government planning, international conferences, backroom deals, not market realities. This is the birth of what our sources properly call monetary nationalism, the idea that each nation's money is a tool of state policy, not a market good.
And the first big attempt to formalize this new political management of money was the Treaty of Genoa in 1922.
Genoa was ground zero for this new era. It was where they really tried to build an international system where currency values and supply weren't set by gold flows and market prices, but by agreements between governments and central banks.
What was the key mechanism they came up with?
The big innovation, if you can call it that, was establishing the US dollar and the British pound sterling as reserve currencies, meaning other countries could hold dollars or pounds instead of gold as their official reserves.
Ah, so it propped up the pound. Britain was struggling with an overvalued currency after the war, weren't they?
Desperately, Britain wanted to return the pound to its pre-war parity, which was way too high. They hoped that if other countries held pounds as reserves, it would lessen the demand for Britain's dwindling gold stocks.
So they were trying to have their cake and eat it too. Keep the old gold value, but allow for the inflation that had already happened.
That's exactly what they were trying to do, create a sort of gold standard leet, the gold exchange standard that looked stable but allowed governments wiggle room to inflate. It was fundamentally contradictory.
And did it work? Did it stop the gold drain from Britain?
Not really. Gold kept leaking out of Britain, mostly flowing to countries with stronger economies and more credible currencies at the time, particularly the US and France. The market reality kept asserting itself.
Which led the Bank of England to make a rather desperate plea.
Yes, the Bank of England governor, Montague Norman, basically went cap in hand to his counterparts at the central banks of France, Germany, and crucially, the U.S. Federal Reserve, specifically its powerful New York branch head, Benjamin Strong.
What did he ask them to do?
He asked them to inflate their own currencies, to deliberately pursue easy money policies, lower their interest rates, expand credit.
Why? To make the dollar and franc less attractive relative to the pound.
Exactly. If their currencies were also inflating and losing value, maybe the gold wouldn't flow out of London quite so fast. It was an attempt at coordinated international currency debasement to save the overvalued pound.
And Benjamin Strong at the New York Fed, he went along with it.
He did. Strong agreed to help Britain, and the Fed pursued an inflationary easy credit policy through much of the mid to late 1920s.
And this is the direct fuse leading to the Roaring '20s bubble in the U.S.
That's the argument our sources make very strongly. While it might have slightly, maybe, slowed the gold drain from Britain for a while, the main effect of the Fed's deliberate inflation was domestic. It poured fuel on the fire of the U.S. economy.
Creating huge bubbles.
Massive bubbles, particularly in real estate. Think Florida land boom and, of course, the stock market mania that defined the era. Strong was essentially importing Britain's monetary problems and sacrificing American economic stability for an international political goal.
Which inevitably led to the crash in 1929. Now, the standard story you often hear about the Great Depression that followed is that President Hoover was too hands-off, too committed to free markets.
Right, the old laissez-faire Hoover narrative.
And that things only got better when FDR came in with the New Deal and abandoned the gold standard.
Yeah, our sources basically call that narrative, nicely put, nonsense. It's just not what happened.
So Hoover wasn't passive.
Far from it. Hoover intervened in the economy more aggressively than any previous U.S. president. He launched huge public works projects, like the Hoover Dam. He jawboned businesses relentlessly to not cut wages, even as prices were falling.
Maintaining artificially high wages.
Exactly. He also pressured the Fed to expand credit even further. He pushed for price supports for farmers, trying to keep agricultural prices high. And most infamously, he signed the Smoot-Hawley Tariff Act in 1930.
Protectionism. Huge tariffs.
Which absolutely crushed international trade at the worst possible moment. All these interventions, particularly the wage and price fixing, prevented the necessary market adjustments and arguably turned a recession into a full-blown, decade-long depression.
So when FDR came into office in 1933, the New Deal wasn't a radical break from Hoover's policies.
According to this analysis, no. It was largely an amplification and extension of the interventionist path Hoover had already started down. The core problem persisted.
Which was
the insistence on trying to fix wages and prices at the unsustainably high levels of the 1929 boom. When businesses can't lower wages to match falling demand and falling prices, they can't afford to keep people employed. That's how you get 25% unemployment.
And the agricultural policies, burning crops while people starved.
It sounds insane, but it happened. Price supports led to massive surpluses that couldn't be sold at the fixed price, while millions were hungry but couldn't afford the artificially high prices. It's a classic example of central planning creating shortages and surpluses simultaneously because the price signals are broken.
So, when all this intervention failed to fix the depression, the conclusion drawn by the policymakers wasn't maybe intervention is the problem.
No, the conclusion was the gold standard is the problem. It was the constraint. It limited their ability to inflate the currency and spend even more. So the constraint had to go.
Which led to Roosevelt's executive order in 1933.
Executive Order 62102, a truly radical step. It prohibited American citizens from privately owning gold coins, gold bullion, or gold certificates.
They had to turn in their gold.
They were forced to sell their gold to the U.S. Treasury at the official price of $20.67 per ounce. It was essentially a government confiscation of private wealth.
And once the government had vacuumed up the private gold, then they changed the price.
Immediately. After collecting the gold at $20.67, FDR unilaterally devalued the dollar internationally, changing the official gold price to $35 an ounce.
A massive devaluation overnight.
A 41% cut in the dollar's official gold value. This wasn't some arbitrary move. It was the inevitable consequence, the official recognition of all the inflation that had occurred since the Fed's creation in 1913, and especially during WWI in the 1920s. The U.S. was now fully off the gold standard domestically, and the era of government-controlled fiat was truly underway.
Right, so you have the gold standard dismantled, first internationally during the war, then domestically in the U.S. in 33. This leaves a huge intellectual and policy vacuum. What fills it?
John Maynard Keynes. John Maynard Keynes. His ideas, focusing on aggregate demand, government spending, managing the economy from the top down, they provided the perfect theoretical justification for this new world of government-controlled money.
And the core idea is incredibly seductive for politicians, isn't it? If the economy's slow, the problem is always just a lack of spending.
Always. It's never structural issues, never malinvestment from a previous boom, never bad regulations. Nope, just not enough spending.
And the solution is therefore simple.
Simple. The government needs to spend more, or the central bank needs to engineer more private spending through lower interest rates and currency debasement.
Which discourages saving, right? Because saving is money not being spent.
Fundamentally, saving becomes the enemy in this framework. And imports are bad too, because that's money spent abroad, not domestically. So it leads naturally towards deficit spending, inflation, and protectionism. It's a politician's dream toolkit.
But our sources highlight a really striking admission from Keynes himself about the political implications of his own theory.
It's quite remarkable, yeah. In 1937, in the preface he wrote specifically for the German edition of his major work, The General Theory. Remember the context. Nazi Germany is consolidating power.
Okay.
Keynes writes, and this is a near quote, that his theory of aggregate production is much more easily adapted to the conditions of a totalitarian state than it is to a system based on free competition and a large measure of laissez-faire.
Wow. He actually said his ideas fit better with totalitarianism.
He saw that a system based entirely on centrally managing aggregate demand requires, or at least works more easily with, a powerful state apparatus that can direct resources and compel spending. It's a chilling admission, frankly.
And this shift in thinking had a profound impact on universities and economics itself.
Absolutely. Academic economics, particularly in the leading universities, gradually shifted away from trying to understand the timeless principles of human action and market coordination.
Towards training technocrats.
Towards training managers of the national economy. How to fine-tune aggregate demand, how to manage inflation targets, how to advise government agencies. The older classical liberal tradition, emphasizing individual choice, property rights, sound money, limited government that got pushed to the margins, became unfashionable, even seen as obsolete.
This new Keynesian paradigm also gave rise to a very persistent historical myth that World War II is what cured the Great Depression.
Oh, the WWII recovery myth. Yes. It's a cornerstone of the argument that government spending drives prosperity. Look, they say the government spent massively on the war and unemployment vanished. Depression over.
But GDP figures don't tell the whole story, do they? Spending billions building tanks that get blown up or paying soldiers to fight. That boosts GDP, but is it real economic recovery?
Not in any meaningful sense for the average person. Life during World War II, even in the U.S., which wasn't bombed, was defined by austerity, severe shortages of consumer goods, strict rationing of everything from gasoline to sugar to meat, price controls everywhere.
No new cars being built, no new houses.
Exactly. Resources weren't going into improving living standards. They were being poured into the war effort. Millions of productive workers were taken out of the labor force and sent overseas. To call that period an economic recovery, just because GDP went up and unemployment went down, it ignores the reality of life for most people. War is destruction, period.
Which makes what happened after the war even more telling, right? Because the Keynesians predicted disaster again.
They absolutely did. Leading economists, people like Paul Samuelson, who wrote the standard textbook for decades, predicted that as soon as wartime government spending was cut, the U.S. would plunge right back into depression. Mass unemployment, industrial collapse, the works.
And what actually happened when the war ended? Did the government keep spending?
No. This is the crucial part. Between 1944 and 1948, the U.S. government slashed its spending dramatically by about 75%.
75% cut, that's huge.
Massive. And at the same time, they dismantled most of the wartime apparatus, price controls were lifted, rationing ended.
So according to Keynesian theory, disaster should have struck.
Should have been Armageddon. Instead,
The U.S. economy boomed.
exploded. One of the biggest economic booms in American history.
Yeah.
The market effortlessly absorbed almost 10 million returning servicemen back into the workforce. Factories switched from tanks to cars, from bombers to washing machines.
How? Without government spending driving it.
Because the spending wasn't the driver. Free prices were the driver. Lifting price controls allowed supply and demand to coordinate again. Entrepreneurs saw opportunities, invested capital, hired workers to produce things people actually wanted to buy after years of wartime deprivation. It was a massive, real-world refutation of the idea that government spending is the key to prosperity.
But despite this real-world evidence, the political momentum was already behind the managed currency system, which brings us to Bretton Woods in 1944.
Right. Even as the war was ending, the Allied powers met at Bretton Woods, New Hampshire, to design the post-war global financial system. This was the moment monetary nationalism went fully global and institutionalized.
And the key architects were Keynes again, for the UK.
And Harry Dexter White for the U.S. An interesting figure, White. He was later exposed as having significant connections to the Soviet Union, possibly even being an agent.
Seriously? So the post-war capitalist financial system was co-designed by...
Well, let's just say the influences were complex. But the system they created became known as the Bretton Woods system, or the gold exchange standard.
How did it work? What was the structure?
Okay, the core idea. The U.S. dollar was crowned the world's primary reserve currency. All other major currencies, the pound, the franc, the mark, the yen, would fix their exchange rates to the dollar.
And the dollar itself, was it backed by gold?
Only the dollar remained officially convertible to gold, but only for foreign central banks, not for private citizens. And the fixed rate was $35 per ounce.
So other countries held dollars as reserves instead of gold, trusting the U.S. to maintain that $35 link.
That was the deal. In exchange for dollars, other countries transferred enormous amounts of their own gold reserves to the U.S. for safekeeping, mostly held at Fort Knox and the New York Fed. It effectively made the U.S. Federal Reserve the central bank for the entire world.
The idea was to mimic the stability of the old gold standard, but with more flexibility, managed stability. Managed stability, exactly, via centralized planning. But of course, there were escape hatches built in. Governments could adjust their currency pegs if they faced a fundamental disequilibrium, a conveniently vague term. And the International Monetary Fund, the IMF, was created basically to manage this inherently unstable balancing act.
This system gave the U.S. a truly unique position, didn't it? Something the French economist Jacques Rueff famously called the deficit without tears. An absolutely brilliant phrase. Deficit without tears. What did it mean? Because the whole world had to hold and use U.S. dollars as reserves, the U.S. government could run huge budget deficits, pay for massive military spending, fund ambitious domestic programs.
Simply by printing more dollars.
Simply by printing more dollars. If they spent more than they took in via taxes, they could just create the difference. Other countries would soak up these excess dollars as reserves, so the U.S. could buy real goods and services from the rest of the world, effectively financed by inflation, without immediately feeling the pain, the tears of higher taxes or a currency collapse.
Like the Roman Empire debasing its coins, but on a global scale.
A very apt comparison. It fueled the massive expansion of the U.S. military-industrial complex after WWII, the Vietnam War, Lyndon Johnson's Great Society programs, all facilitated by this ability to finance spending through dollar creation that the rest of the world was obligated to accept. It created this powerful political dynamic where more government spending funded by inflation became the norm. Of course, a system built on one country's promise to maintain discipline while giving it every incentive not to couldn't last forever. The Bretton Woods system was inherently fragile.
And the weak link, that $35 an ounce promise, became more and more strained as U.S. inflation picked up in the 1960s for Vietnam, for the Great Society.
Exactly. The U.S. was printing far more dollars than could plausibly be backed by its gold reserves at that fixed price. Foreign countries holding those dollars started getting nervous. They saw the purchasing power of their reserves dwindling.
And they started asking for their gold back.
They started asking. The first real sign of trouble was the London gold pool in the 60s.
What was that?
It was a consortium of the U.S. and several major European central banks who secretly agreed to pool their gold reserves and sell gold on the open market whenever the price threatened to rise above $35 an ounce. They were trying to artificially suppress the market price.
Trying to hold back the tide.
Trying to hold back the tide, but the pressure was immense. The pool eventually collapsed under the strain. Then you had key countries, most famously France, under President Charles de Gaulle, becoming much more assertive.
De Gaulle famously sent a warship to New York Harbor.
Well, maybe not a warship, but he did send the French Navy to physically retrieve France's gold reserves held by the New York Fed. It was a huge symbolic gesture, basically saying, we don't trust your paper anymore, give us the real stuff.
And other countries tried too. Germany?
Germany asked for some of its gold back, yes. The U.S. reportedly stalled, made excuses, refused large redemptions. The writing was on the wall. The U.S. gold stock was shrinking rapidly. They couldn't maintain the $35 peg credibly anymore.
Which leads us to August 15th, 1971, the Nixon shock.
The day the music stopped, President Nixon went on television and announced that the U.S. would unilaterally suspend the convertibility of the dollar into gold. He called it temporary.
It wasn't temporary.
It was permanent. That single announcement officially severed the last weak link between the global monetary system and gold. The process that began with the guns of August 1914 was finally complete. The entire world was now on a pure, non-redeemable, floating fiat currency standard.
And what were the immediate consequences of just cutting the anchor?
Chaos, initially. But the longer-term consequence was a fundamental shift in how international trade worked. Without gold as a final settlement asset, without fixed exchange rates, the world reverted to something the economist Hans Hermann Hoppe called a system of partial barter.
Partial barter. That sounds primitive. What does it mean in practice?
It means that instead of having one global money, you now have dozens of national fiat currencies floating against each other. So every time goods or services cross a border, someone has to engage in currency exchange.
A German company selling to Japan has to worry about the euro-yen exchange rate?
Exactly. Which currency do they price in? Who bears the exchange rate risk? This necessitates constant currency trading, hedging, speculation. It's why we have the absolutely enormous foreign exchange market, the FX market.
How big is that market?
The daily trading volume is staggering. Something like $5 trillion, maybe more now. Think about that. Trillions of dollars changing hands every day just to facilitate trade that used to happen much more simply under a gold standard. That entire market represents a massive inefficiency, a deadweight cost imposed on the global economy entirely because we lack a single, stable international money.
And once the dollar was untethered from gold, what happened to its supply and its value?
Predictably, it exploded. If you look at M2, a broad measure of the U.S. money supply, in 1971, it was around $600 billion.
And today?
Today, it's well over $20 trillion. That's an average growth rate around 6–7% per year, year after year, far outpacing actual economic growth.
And the flip side, the price of gold.
Gold went from the fixed $35 an ounce in 1971 to, well, it fluctuates, but it's been anywhere from $1,200 to over $2,000 an ounce in recent decades. That's not gold becoming magically more valuable. That's the paper dollar losing the vast majority of its purchasing power against a stable benchmark.
So that's the U.S. story, the core of the system. What about the track record of fiat globally since then?
If the U.S. looks bad, the global picture is often far, far worse. Our sources cite World Bank data covering 167 countries between 1960 and 2015. The average annual growth rate of M2 money supply across all those countries
Was
32.16% per year on average.
32%. That's just institutionalized wealth destruction on a global scale.
It really is. And this constant rapid expansion of fiat money supply is what enables the ultimate monetary catastrophe, hyperinflation.
Which, as you said earlier, seems unique to government paper money.
Absolutely unique. You simply do not find historical examples of hyperinflation usually defined as prices rising by 50% per month under a metallic standard like gold or silver. But since WWI, under fiat regimes.
No many times.
There have been 56 recorded instances. 56 times the governments have inflated their currency into utter worthlessness, destroying their economies in the process.
Weimar Germany in the 1920s is the classic example.
The classic, horrifying example. Wiped out the savings of an entire generation, destabilized the country, and directly paved the way for the rise of Hitler. And we see echoes today. Venezuela, Zimbabwe, Argentina. The pattern repeats. Fiat money allows for levels of monetary abuse that are impossible with commodity money.
So given this history, instability, inefficiency, recurring hyperinflation, why on earth does this fiat system persist? Why hasn't the market just rejected it and found something better?
Because the system isn't based on voluntary acceptance or economic merit. It's maintained by the power of the state through several key mechanisms of coercion.
Okay, what are they?
Pillar 1, taxes. Governments demand taxes be paid exclusively in their own fiat currency. This creates a baseline, inescapable demand for it.
You have to get hold of it to pay the tax man.
Exactly. Pillar 2, control over the banking system. Governments heavily regulate banks, dictate reserve requirements, and effectively control the entire financial plumbing, making it very difficult for alternative monetary systems to gain traction within the official channels.
Pillar 3.
Legal tender laws. These laws typically mandate that the government's fiat must be accepted for the payment of debts. While they can't force saleability, as we discussed, they can make it illegal to refuse the government's money for settling past obligations.
And the fourth pillar. It comes back to gold, ironically.
It does. Despite abandoning gold domestically, central banks still hold massive gold reserves, around 33,000 tons globally, last I checked. Why? As the ultimate backstop. To settle large international balances between themselves and to maintain some semblance of credibility for their fiat currencies on the world stage, they rely on the very asset they deny their own citizens.
So this government control transforms money, doesn't it? From being a reward for producing value that other people want.
To being in many ways a tool of control, a reward for obedience. The government can confiscate your wealth slowly through inflation. They can freeze your accounts. They can even demonetize large notes overnight, like India did in 2016, forcing everyone to prove the legitimacy of their cash holdings. Control over money is ultimately about control over people.
Which brings us back, after this whole historical journey, to defining what real sound money would actually look like, based on the principles of Menger, Mises.
Right. If we synthesize their insights with this history, sound money needs to meet two crucial criteria. First, obvious one. It has to be freely chosen by the market. People have to voluntarily adopt it as the best medium of exchange because it serves their needs, stable value, divisible, portable, etc.
Okay, chosen by the market. What's the second criterion?
This is the one violated by the entire 20th century. The money must remain completely under the control of its lawful owner. It cannot be subject to arbitrary confiscation, inflation, or censorship by any third party.
No central bank debasing it, no government freezing it.
Exactly. If a third party can manipulate the supply or seize the asset, the temptation will always be there, and history shows that temptation eventually wins. That third-party control is the Achilles heel that fiat money introduced, and sound money must eliminate. Hashtag tag outro.
So, summing up this deep dive, we've traced a century-long arc, haven't we? Starting with World War I, enabling governments to break the link with gold.
Replacing the market's choice with government decree.
Leading through the instability of the interwar years, the managed system of Bretton Woods.
Which inevitably collapsed into the pure fiat system we have today, this monetary nationalism.
A system marked by constant inflation, inefficiency, periodic crises, and the ever-present risk of hyperinflation.
And the core problem, as we've seen, is that when the cost of producing money is near zero, the only constraints left are political. And political constraints have consistently proven weak over the long run.
It leaves you wondering, is there a way out? Which brings us to a final thought, maybe a provocative one, from the philosopher F.A. Hayek.
Hayek. What did he say?
Speaking back in 1984, long before our current digital age really took off, he argued that we probably wouldn't see sound money return until we, quote, take the thing away from the government. He basically said, we can't get good money by asking them nicely.
We need to introduce something they can't stop.
Exactly. Find some way to introduce it stealthily, something they couldn't control. We've just spent this whole discussion looking at a century defined by the state taking control of money, moving from gold to fiat. So the question Hayek implicitly poses, and that resonates today, is what happens when the market introduces a new potential form of money, something highly saleable, maybe digital, that exists outside the state's control, resistant to inflation, resistant to seizure.
A technological end run around monetary nationalism.
Perhaps this potential shift from gold to government fiat and now maybe towards something decentralized and sovereign, that feels like the next chapter in this long, deep dive into the nature of money. Something for all of you listening to definitely think about and explore further.